RSI and MACD, a powerful combo for entry points. In the world of technical analysis, few tools are as widely used as the Relative Strength Index, RSI, and the Moving Average Convergence Divergence, MACD. While each is powerful on its own, combining the two can provide high probability entry points that align with both momentum and trend. Let's start with a quick breakdown. RSI is a momentum oscillator that measures the speed and change of price movements, typically on a scale from 0 to 100. Readings above 70 indicate overbought conditions, while readings below 30 indicate oversold. However, RSI is best used to spot divergence or confirm strength, not simply as a signal to buy or sell. MACD is a trend-following indicator that shows the relationship between two moving averages, usually the 12 EMA and 26 EMA. The MACD line crossing above the signal line suggests a bullish trend, while a cross below suggests a bearish trend. It's especially helpful in identifying trend reversals and momentum shifts. Now here's where it gets interesting. Using RSI and MACD together filters out false signals and gives you more accurate trade entries. How the combo works. Confirm the trend. With MACD, wait for a bullish MACD crossover. MACD line crosses above signal line as a first step. This shows upward momentum. Look for pullbacks with RSI. Once the trend is confirmed, wait for the RSI to drop into oversold territory, e.g., around 30 to 40, then bounce upward. This indicates a potential low-risk entry in the direction of the trend. Divergences matter. If MACD is making higher lows while RSI is making lower lows, it may signal a powerful reversal. Example: MACD shows a bullish crossover on the daily chart. RSI drops to 35 during a pullback but begins to rise. This combination signals a great buy opportunity within the trend. By aligning MACD's trend signal with RSI's momentum indication, traders can reduce noise, increase precision, and improve their entry timing.